All right, personal finance gang. This is the last piece of the investments basics puzzle that we'll be putting together. Next week, we'll go on to some more topics, but this is the last for this week. So, what we're going to do is talk just a little bit about how you might set up a portfolio, again, real briefly here. And when we get to mutual funds, I'll even tell you about a fund that will make portfolio adjustments semi-tailored for your needs. But to get started here, a portfolio is just a collection of securities or a collection of investments. So our goal with forming portfolios is to lower our risk without hurting expected returns. So remember, I said last time that investors most investors are risk averse. That means they like more return, but they prefer less risk with that. So with a portfolio, we pick a return level or desired return level where we're comfortable with the risk we're taking on. We try to get lower the risk amount for that return level we have in mind. Now, diversification, the reason we form portfolios, we could put all of our money in Apple Computer stock and maybe we'd have ended up being real happy. But then again, Apple Computer tomorrow could say they're shutting down all their stores for a year or all their manufacturing facilities for a year with the given environment, who knows. But the idea behind diversification is don't put all of your eggs in one basket. You've heard that saying before. So instead of betting it all on Apple, maybe you hit a big home run and win, but if Apple crashes and burns, you lose. So you spread your investments around. You don't invest all in one stock or necessarily all in one category of securities. So up next, we're going to talk about categories of securities. Diversification involves more than just picking multiple stocks. You have choices on where you can put your money, and these choices often have a bigger impact than the individual securities you pick in the categories. So these are just a few of the choices you have on where you could put your money. So you could buy U.S. stocks, for example. So some of your money could go into the stock market, individual stocks, or you can buy into indexes using ETFs or mutual funds. More on that later. And remember, when you buy stocks, what are you doing? You're becoming a part owner. If you own stock, you're a part owner. If you buy a bond, you're lending money. So these are things you could do with your money. You could become a part owner by buying stock. You could lend money by buying bonds. You could put your money in a relatively safe place. This is roughly a cash equivalent, not guaranteed. Money market, this could be money market / cash. So consider this the real safe piece without volatility. So more on this later, but stocks are the riskiest of these three, have the highest expected return. Bonds are a little bit less risky, but generally don't have as big a payoff, but won't fall as far. Money market securities, generally not going to fall at all. They try to maintain a set $1 value, or you could put this in cash, guaranteed by the government, or in a savings account guaranteed by the government. Your $1, every dollar you put in there, you get that back. But these pay a real low rate of interest typically. So these are some U.S. choices, the typical big categories. You could also invest outside the U.S. So there are easy ways and there are harder ways, but you can invest in foreign stocks. You can invest in foreign bonds. You can invest in foreign currencies and stuff. That's getting more out there, though, for us. But anyway, so you can invest in foreign securities. You can invest in real estate. You can invest in commodities and such. So, if you think the price of oil is going to bounce back up, oil's right now down at like $20 a barrel, really low historically. But so there's all these different investments you can make. And, actually, you don't have investing in foreign securities. That sounds hard. How do I know how to get securities from Germany? Well, you don't even have to do much shopping around for that. We'll see later that there are mutual funds and ETFs, so you can buy a whole global portfolio with one purchase. Real estate, there are investment real estate securities that you can buy. Instead of having to buy them directly, you can buy them through mutual funds and ETFs, the same with commodities. But so back to the big picture here, what percentage of your money should go into these different categories? It depends on your goals, it depends on your time horizon, depends on your risk tolerance. We're not going to get too deep into this, but that's the idea, is how do you spread your money between these categories? So your objectives, your goals are going to affect how you allocate your money. So if, let's say, you're suddenly retired now, what you want from your portfolio is cash flow. So that's going to have an impact on the classes, back up, that's going to have an impact on the classes of securities you buy and maybe the securities within those classes. So that's a current income approach. You need regular cash flow. A total return approach is, hey, I want a mix of income and capital gains. Well, the current income, back to this, if you're living on your portfolio, you don't want to take a risk of losing everything, so you'd have relatively low risk. With a total return portfolio, you take on more risk. You're okay with a mix of income and capital gains. Income, let me get back to income here. Income, and we'll talk more on this later, but income with stocks would be dividends that you'd collect, cash payments to the stockholders. With bonds, that would be interest payments. So someone who wants current income would have a relatively heavy weight in bonds because they pay interest, and then maybe some higher yield dividend paying stocks. Total return, you take on a little bit more risk, get a good bit higher expected return potential there. Capital gains, that just means you're looking for the stock price to go up. A capital appreciation approach means, hey, you want your wealth to grow. So for you right now, most of you are young. If you're saving for retirement, you don't want regular cash flow from your retirement portfolio right now. You're working, or you will be. So imagine you're 22, you got that great paying job, but you're saving 10 to 15% of your each paycheck. And so you don't need regular cash flow. You don't need, some income, some of the dividends could be reinvested. So you might take on moderate risk, but primarily you're interested in, hey, you're starting out small, 10% to 15% of your first year's pay. You're not super wealthy. You want that to compound and grow over time. And some of you may be thinking, holy moly, that stock market just dropped 34%, and this guy's telling me to invest in stock. Well, actually, this is super good for you guys right now. If you were in a retirement account right now, this is a great time. So instead of getting those high-priced stocks like they were 2 months ago or less, you're now getting them at a much lower price, and you don't need the money for 40 years. So you'd rather buy now at the lower price and get the gains. So dips like this are good for long-term investors. Now, they're not so good for people with gray hair getting ready to retire. Well, I'm still a ways off, so I'm not too worried about it's got a good bit of time to bounce back before I'm going anywhere. Even though my face is looking gray, I'm not in my 60s yet. Just wanted you to know that. But anyway, so what are you shooting for mainly? That's going to affect your portfolio decisions. Then you've got to go, well, what classes of these assets should I buy? I'm going to back up. So, which of these categories fit best with your goals? And if you don't know, again, we'll talk about some ways to simplify this when we talk about mutual funds and ETFs. So what classes of those categories to buy? What percentage of your money should be in each? Now, do you have the most of your money in stock? Should you have most of your money in money market? We'll talk about this more coming up. But if you're saving for retirement and your retirement's a long ways away, you don't want most of your money earning 1.6%. Remember the rule of 72. How long does it take to double your money at a certain rate? If you're earning 2%, it's going to take 72 divided by 2, roughly 36 years to double your money. That's a ways. You know, you don't get one point something doubles in your lifetime or your working career. If you invest in stocks, which right now are getting hammered like crazy, and if you're investing in stocks with a 10% average return over the long run, more like 7 years to double your money. So you double. I mean, you're doubling a whole bunch of times before you get to retirement with stocks. You have the potential, no guarantees. So that's, what classes to buy, what weights. For you younger people, I would be arguing a large weight. If you're saving for retirement, a large percentage of your money should be in stock. If you're investing for short term, that's not going to be the case. And then after you pick, hey, how much in stock, how much in bonds, then you might get to what securities should be in the classes. And you don't even have to get to this case so much here. You could just say, hey, I want to be in the stock market, but I don't know a thing about picking stocks and I don't want to have to worry about it. So I'm just going to be in the entire stock market. There, you could be in the Vanguard S&P 500 index with one purchase. Well, that's got the 500 biggest companies. You could be in even more companies, those 500 big companies and a bunch of small companies. For example, Vanguard has a total market index that you could buy into and have. I think that one tracks a bigger index, and they own like shares of 2,000 different companies. So with one quick purchase, I'm hyping mutual funds. I've got to save that for later. But anyway, you could skip that answer there. But the first thing is how do you want your money allocated between the different asset categories? Now, this is going to be the topic we finish up on the semester, that is a little bit about retirement accounts. We're not going to get deep into them at all, but you'll be hearing more about 401k, 403b, IRA, Roth IRA, and then there's also Roth 401k and Roth 403b. But anyway, we'll talk about those, the last topic of the semester. Now, if we have two twins, same income level, same goal, should they have the same portfolio? Well, different people feel differently about risk. So, not necessarily. You might think, all 35-year-olds, let's back up, all 23-year-olds making at least $40,000 a year must have this percent stock. There is no such rule as that. There are guidelines for what's recommended, but if you're going to be laying awake worried about your portfolio every night for the next 30 years and not sleeping, you might go lighter in stock than somebody else. Now we're going to give some generic rules here for how to decide, risk levels and etc. So here are a few of those. The first one of those, someone that has a higher level of income, should they be able to, in general, take on more or less risk? Well, if you're making $1 million a year and you lose some money in your portfolio, you'll probably still be able to manage to scrape by. So you can afford to take on more risk. And in general, more risk means more stock and, not less bonds and cash and such. Another one of these, if someone has a highly variable level of income, in general, should they take on more or less risk? Well, if your income is unpredictable from year to year or month to month or quarter to quarter, you might be a little bit more conservative in your portfolio because you might be having to rely on some of those funds to help you get by. If you have a higher net worth, so if you're worth $1 million versus $3,000, or let's say $5 million versus $100,000 net worth. So if someone has a higher net worth, can they afford to take on more or less risk? Well, if that person with $5 million in net worth loses 20% of their portfolio, they still got $4 million. Someone with $100,000 loses 20%, they're down to $80,000, and they're already cutting it close. So in general, higher net worth people can afford to take on more risk. Again, that doesn't take into account individuals, but that's just a general statement there. Younger investors, I think I've already touched on this. In general, should younger investors be able to take on more or less risk with, say, portfolios? The answer there is higher risk. This, again, is, say, for saving for retirement. So the reason for this is, again, my white bearded face here. I might shave one day soon. This is my early pandemic look. So for younger investors, the market drops 34%. You're saving for retirement 45 years from now. I'm pretty confident that I have no clue what the market's going to do over the next 1, 2, 3, 4, 5 years. But I'm betting over 45 years, you're certainly going to bounce back and go on beyond there. So you're betting on the country and, you know, the economy and our American way of life, etc. It sound like a music video here, to do well. So you can take on more risk because you've got the longer time horizon and you can recover better. So even if you did lose, say you lose 34% right now, you can modify your savings and save more over the next 40 years, whereas someone closer to retirement doesn't have the compounding. So remember the time value of money, that's why it was so important. You've got more time to adjust if there was something dramatic that happened now versus someone who's right near retirement. So, the worst case to be in would be getting ready to retire next month and your portfolio just dropped 34% and you're going, oh bleep. Okay, here's another thought-provoking question here. What if your investment goals include an earnings level of 13% per year, but you don't want a high level of risk? You're not willing to take on a high level of risk. Well, actually, this one has no good answer. Your goals are not reasonable. You're not going to get 13% with low risk. So to get 13%, you're going to have to take on a higher level of risk. And as I mentioned just a bit ago, higher level of risk leads to higher required return, and that generally means, there are other asset categories too, that generally means for us more stock. So if you want a higher return in general, you would expect to have a higher percentage of your money in stock. You could also, real estates and commodities are also offer higher returns, foreign stock, etc. There are other investment alternatives. But in general, when we're talking about securities and stuff, if you want the higher return, you're going to go with more stock of one type or another in general. I mentioned investment horizon before. Bring it up again. If you've got a short time investment horizon, say 1 to 5 years, do you want, your money in stock? Definitely not all of your money. You may put some in, but certainly if you had a short time horizon, you're worried, the market just dropped 34% and rebounded a little, but it might not get back up to where it was. It could take a few years, or we could have a cure for the vaccine could come out much faster than they expect, or some new medicine could cure things right up. I'm trying to be optimistic here, but 1 to 5 years, definitely not the majority of your money in stock for that investment horizon. If your investment horizon's beyond 5 years, that's where starting to put, more and more of your money towards stock because of the good return potential. Now here's a note that's not guaranteed to repeat itself, but stocks have beaten bonds over most 20-year periods, but not all. Actually, the periods of time where bonds have outperformed, where one thing about long-term bonds, if interest rates are high and then they fall, bond values go up. So during periods of high interest rates, bonds may be a good payoff, provide a good payoff in a couple ways. One, you get, a big interest rate from them. And then if the interest rates do fall, the value of your bonds go up over time until maturity. But anyway, right now we're at a period of very low interest rates. There's not a whole lot of room for interest rates to fall to drive bond prices up. On risk-wise, during this recent mess here, stocks got slammed, and I had moved money to bonds and thought I was real smart, and then bonds got hammered. So the stocks were slammed, but bonds got beaten down by a lot more than I would have guessed. So even those weren't safe from this, because investors were worried about not just, profits, they're worried about even being able to pay back debt. So bonds got hammered as well. That's kind of depressing. All right, so here's just a generic matrix of asset allocations for longer periods of time or different periods of time. So investment time horizon, how long are you planning to invest for? What's your investment horizon on your goal? Are you saving for something 3 to 5 years out, 6 to 10 years out, or more than 11 years out? And how do you feel about risk? Did that 34% drop in your portfolio scare you half to death? You might be a low risk tolerance investor. Are you kind of like, man, that was nervous, but I'm not getting out? You'd maybe be a moderate risk investor. If that 34% drop made you go, man, I want to pile some more money in right now, that's super. Assuming you had it in and you lost, but you wanted to find more, maybe you're a higher risk tolerance investor. So this is just hypotheticals, different weights here for these. So a moderate risk investor with a short time horizon, 3 to 5 years, relatively short, might be 30% cash or money market mutual funds type stuff, 50% bonds. So it's 80% pretty safe, but still 20% in the stock market because of the return potential. Now the thing about this 20% is if the market goes up, it can add some extra return to your portfolio. And if the market dropped, the market dropped 30%, what's that do? The stock component here, since it's only 20% of your portfolio, means you'd get about a 6% loss just from the stock. So a 30% drop, your portfolio is only down in the stock market leads to a 6% drop in this. Unfortunately, bonds went down as well. So those got hammered, these got slammed with the recent coronavirus. So that's a 3 to 5 year investment horizon. If you're saving for the real long term, even the moderate risk investors, I'll say relatively long term there, generic recommendation, 80% of your money in stock, 20% in bonds. The bonds add a little bit of stability there, help protect you some on the downside, and there are periods of time where bonds perform better than stock. Okay, so and a higher risk investor, for that long time horizon might be 100% stock. And even our low risk investor, the advice for them is to have 60% stock. The reason for that, again, I mentioned, if you're going, hey, I'm afraid of risk, but if you have all your money in cash, it takes forever to double it, those low returns. Now, saving for retirement, one generic rule of thumb is what percentage of your money should be in stock? 100 minus your age, put that percentage in stock. And so if you're 20, you'd have 80% of your money in stock. The more aggressive version, I think I like the aggressive version more, well, I know I do, 110 minus your age. So a 20-year-old would have 90% of their money in stock. Now, what you notice happens as you get older, your allocation to stock goes down, your tolerance towards risk decreases, and I can attest to this as you get closer and closer to retirement, and you're going to need those funds. So, but again, this is just a generic rule of thumb. No hard and fast, you must do this. Everybody's different. So this was just getting us started on some of these topics. We're going to see more on stocks and bonds to know a bit more about what the securities are that we could potentially be buying. And then we'll see more on mutual funds and ETFs, which are ways to get into those stocks and bonds without having to buy them directly. Those are coming up. Everybody be safe out there, and holler if you have questions.